We are going to talk about customizable funds today. And a lot of you, might be sometime down the line, whether you should do customizable funds. But I think there are a lot of hype and perhaps myths about customizable funds. My general advice is start with a syndication, then move into funds. And then when you go into funds, SPV funds is what you should do first within the fund. And then at the end, you can do customizable funds. But sometimes you never end up doing customizable funds, which I will explain why toward the end. So today's whole topic is about customizable funds. All right. So again, syndication is where you get started. That's the crowding part. The crowding, the SPV is the walking, and the customizable funds is where you want to run, but you may never get there, or you may not want to get there. So let's explain a little bit about funds. Just putting funds in context. Okay. When you are, what is the purpose of funds versus syndications? Okay, let's talk about that. When you're trying to buy a large piece of real estate, you have to have the money for the down payment or be able to get the loan and put down the down payment. There are three broad ways that you can get the money, or three different types of speeds in which you can get the money. The first one is you have the money. Okay, so there you have the money. And so that's down payment super easy. Down payment super easy. And so the first way is, by the way, syndication, which is raising money after under contract, right? So this is the way that we typically know about it. Now, within the you have the money, there's the office, family office. Basically, it's just their money, right? You have the money up front. And so you can imagine by having the money, you don't have to worry about that variable, and you are able to close on the transaction more easily. Then there is something in between, which is fund. The idea behind a fund is that you raise before you go under contract. You basically have the money ready before, and by the time you go under contract, you have the funds available, right? This is where the multifamily and these large commercial transactions differ from single families. Okay, so that's the purpose of a fund, which is to raise money before you go under contract, which is kind of like a family office. All right. However, there are many variations of it, but that's the essence of a fund, which is have the money ahead of time, so you don't worry and you have these anxieties during the phase of closing on something. All right. Now, to be clear, there is also a fund. There is also funds that raise during a syndication, meaning that while the property is closing. So that also happens. But in general, the main purpose of fund is to raise before you go under contract. So within the fund, so this is we're putting fund in this big spectrum. And then within the fund, there are two main types of funds. One is the single purpose vehicle funds. The other one is a customizable fund. The single purpose fund, as its name entails, is that it has a single purpose, which is to invest in a syndication or into another bigger fund. Okay. In that case, it's called a feeder fund. It's just feeding that fund. Okay. So that, and the lifetime, the raising of the money is for a particular purpose. It's usually for an asset, or it's like for a startup. And so you can raise $2 million, and that SPV fund takes a LP, a limited partner position, okay, in the bigger fund. Okay, that's what the SPV fund does. And in this, and then there's the customizable fund. The customizable fund, let me actually ask one more thing here, which is a blind fund. A blind fund is it raises money for multiple purposes. Okay, multiple purposes. It could be that you're gonna raise a set of money, say $10 million, of which $3 million goes into asset A, and then $3 million goes into asset B, and then $1 million goes into asset C. Okay. However, GP decides on the allocation of how much money goes into which asset. So GP makes the allocation decision. That's the point. Meaning the LP is cannot determine how money is used among the assets. Okay. The customizable fund is trying to combine the SPV and the blind fund into a single type of fund. It is saying the following. It is saying it has multiple purposes. So a customizable fund, while it has a thesis, it can put some money into oil and gas, some money into startups, some money into syndication, like multifamily, and some money into logistics. Yeah. And it is saying LPX can put 10,000 into asset A, 20,000 into asset B, and 20,000 into asset C. The LP gets to decide that. The GP doesn't. So it's saying that it has multiple purposes. Just invest in my fund, and you get to decide what money goes where. Okay. So it's basically syndication using one legal document. That's why it is. It's an evergreen fund that keeps raising money, but it's raising money for different purposes. Sometimes startup, sometimes oil and gas, sometimes. Okay. So that's the customizable fund. Now, I am sure at this point, if you haven't heard these terms, you might be wondering what is the purpose of it. But let me pause there. Maybe anyone who is curious can ask some questions. Does that make sense? Do the definitions now make sense? And here's one question I have for you. Which one do you think is the most popular among real estate? I'm curious. Does anyone know?
Probably the first one there. Single purpose. It's just to invest in a syndication.
Yeah, that's right. Yeah, your hypothesis is right. This is 85%. And then if you include the blind funds, by the way, SPV is sort of a blind fund. Well, it's it's not exactly blind because you know exactly which thing you invest into. So this one might be 60%, this one might be 35%, and then this one will be 5%. That's the breakdown. So we're actually talking about the most rare one among all the types of funds. Okay. But why there's so much interest? It has a lot of appeal with certain set of GPs. Okay. Welcome, Sarah. It's a small crowd, so we are explaining about customizable funds. And so first I went through what the funds are, and then I'm going to describe customizable funds purpose. The purpose is the following. The purpose is to save on legal fees. Okay. I'm not an attorney, by the way, so I'm not going to speak on some of the legal concerns of customizable funds. I am more speaking as a business owner on whether you should use customizable funds from the point of view of cost, convenience, marketability, and logistics. Okay. And whether this is a good idea. As a cash portal, as a vendor, we have about half dozen customers that do customizable funds, including some of the larger customers. And so as a software, we do support it. But as a legal entity, here's this webinar is focused on that. So the purpose of the customizable fund is save on legal fees and create this sense of being evergreen. Okay. Okay. So that's the purpose. Now, let me give you an example of savings. So I'm a GP and I am interested in many different things. I live in Houston. I have some in connections to startups back at home, say in India, and I'm obviously close to people who are in multifamily, and I know some co-GPs from San Francisco or LA that are doing logistics. And I want to be able to raise money from my friends to, wow, I'm not even showing my video. Look at that. Wow. I want to raise money from my friends and put about $500,000 here, $500,000 there, and $800,000 there. Okay. I'm not trying to raise $2 million for each one of those things. I'm only raising 500K. Take a 500K investment. Okay. I'm a co-GP. And if you're a co-GP, you are at most 80-20 split, maybe most likely 90-10 split. Okay. What does that mean? That means if that 100K becomes $1 million, okay, in 5 years, okay, which is pretty much doubling your money in 5 years, then you are going to make basically 80% of 500K, 20% of 500K. Now, obviously, there's the acquisition fee, management fee, da. But when you do all the math, it's basically this one. It's $100,000 over 5 years. Keep that in mind. Okay. So you're basically not making much on that one as a GP. So if and then creating a PPM from scratch is about $12,000 a year. $12,000 for that is a one-time fee. It's not per year. So it basically eats into like 12% of your income if you have any income. And some of these deals you may actually lose money and you may not make anything. And so you're doing $12,000. And if you are raising for 3 or 4 of these assets, you are constantly putting out 12 to 15K attorney fees. Okay? So that is the perceived value of cost savings. What if you create a structure that is, say, 27K or say $15,000 and that's evergreen. Basically, you don't have to raise money. You don't have to keep asking the attorney to create those PPMs. That was the essence of customizable funds. Okay. Now, then they make all the legal work and so on. Legally, again, I'm not an attorney, but I know enough because this customizable funds actually has a place in some of the marketplaces, alternative investing crowdfunding websites. Basically, it creates a Delaware Series LLC. So you have a Roman numeral 1, 2, 3, 4, 5, 6. And then each one of them is tied to the overall fund. And then each one of them can individually own assets. Okay. And each one of them don't have each legal liabilities with one another. That's how they are able to make sure that asset A's performance doesn't affect asset B's investors. Okay. That's how but all of that stem from this economic incentive, which is how can someone that has many interests and usually raise about 500K for each one of those investments, have a economical mechanism to save money on my legal fees. Huh? So, okay. So the pros is the following. The pros is it saves on legal fees. Okay. The cons, the other pro is gives the LP the choice on how much they want to invest, right? Because if you want to give the LPs the choice, hey, invest 50,000 with me, invest 25,000 into this oil and gas, they could easily also create just a bunch of single purpose vehicles for each one of them. But the problem is you're spending $12,000 in each one of them. You see what I'm saying? So, but how can you create something that is a total, but not a blind fund? Because a blind fund doesn't give the LP the choice to invest in any one of those assets. So those are the two pros. Save on legal fees and give the LP the choice on how much they want to invest into each asset. Okay. So far, so good, right? All right. So those are the two main pros. And then this gives a sense of like one and done. Means that the GPs don't ever have to worry about creating another PPM. Like feels and then the other pro is I feel self-contained and kind of powerful. Like they just like I have this one thing that seems very flexible, a Swiss knife that can raise any money and sounds really good. So those are the pros. I don't have an opinion on this is the way to go or not. As a vendor, we have to support it. So let's talk about some of the cons just from first principles. Okay. Let's talk about one of the cons. So maybe before I say it's a con, let's talk about actually one of them. Let's talk about marketability. So we have found, and some folks also told us, some legal counsel told us that statistics. It turned out that 50% of the customizable fund of funds never raise any money. Okay. They never raise any money. And that's just, and usually they have never been a syndicator, so that play a role as well. But they kind of like skip the syndication step and go straight into raising this customizable fund. The reason is LPs don't like this kind of like Series LC thing, a Delaware Series LC, and they don't really know what they are invested into. I know they're like, I'm investing into this oil and gas, this project, but it is actually investing into a LLC, then which in turn takes an LP position into it. But then there is the master fund LLC that's governing it. They just like, I'm like confused. Whereas with the syndication, you know exactly what you're investing to. The LLC owns the asset, period. And there might be a manager that manages the LLC, but that's it. Anything happens to it, they have their own bank account, right? Here, it gets a little bit confusing. The second one is the fund is evergreen. And so what happens is that there's basically no track record. Like they can say, can you give me the net asset value of your customizable fund? They're like, I don't really know how to calculate that. And I need to go and fetch all of them. And honestly, even if I calculate, it doesn't mean anything to you because you may not have equal shares among all of the, it depends on your portion of each one of them. You see what I'm saying? And so there's no track record. And let me actually take a detour here and then let me go to Open Door Capital. Open Door Capital here. Let's go to Open Door Capital. And people ask me, like, if you have a choice between evergreen fund and a closed-ended fund, what would you choose? Because evergreen means I can keep changing tranche one, tranche two, tranche three. Evergreen means I have one fund, one PPM that will last me for the entirety of my entire investing journey, right? Whereas closed-ended, it has a explicit start date and explicit close date. And you are spending $15,000 on each one of them. Is it ever worth it? And the reason that the biggest GPs in the space, such as Open Door and Joe Ferris, Ashcraft Capital, they are almost always doing closed-ended funds. They have all the resource in the world, and yet they still do closed-ended funds. And I talked to some of them, and the answer is the following. The answer is marketability. Look at this. Would you want to invest, like the fact that you see Fund 1 has a 35% exit IRR, does that make you want to invest, take a shot on Fund 11? The fact that Fund 2 has closed and is generating money, does it want to make you to not miss the boat on a future fund? If you have an evergreen fund, it never had a closure. You never had you had a track record. And so the way I think about it is the money you pay for a closed-ended fund, okay, is basically marketing dollars. People think the money you pay to the attorney, you should save it, but I actually think the money you pay the attorney to create this fund 1, fund 2, fund 3, which is individual funds that have nothing to do with each other, it's marketing. It's marketing dollars. It's not really attorney fees. Okay, so that's that. So the fact that both of them, the fact the LPs don't really know what they're investing into, even though they have the choice of 50,000, 25,000, means that they are wary about the thing they're investing. The second reason is the fact that this is evergreen. So they won't really know how everything is performing. Okay. Now you can argue against that, obviously, by putting in like this fund consists of 5 different assets, and these are the performance of 5 assets. So there is a workaround. That's a fair point. So one of the reasons, the cons, I will say marketability. Okay, marketability. So market. Let's talk about costs. So we think that cost is one of the biggest pros of customizable funds. Right, you get to save on legal fees with this one Swiss knife a PPM that can do all kinds of assets. Um, and here is my thesis statement: is whatever you save PPMs and legal docs, you make it up in accounting. Yes, yeah. So here, so and because we are like very, very deep into the weeds, okay? Whatever you save on the legal fees, someone has to rearrange these assets into buckets, and they have to assign ledger items on them, and then you end up with a large accounting bill. And you might say, how hard can that be? You have asset one, you have asset two, and you have asset three. Each one of them has a P&L, right? P&L, and then each one of those has P&L. And then all you have to do is you take the investors in each one, calculate the asset value of each one of those assets, and then at the end, you generate a single K1. Oh, one of the pros is that the LPs that invested in, say, 5 different underlying syndications get a single K1. Look at that. That's amazing. Get a single K1. Like 5 is just an arbitrary number. You can make it 10 or whatnot, right? Unified K1 that combines all their investments. Isn't that nice? That's a true statement. And so, but in order to do that, it gets complicated. Asset one may have a property level P&L. And in fact, if the customizable fund is investing as a passive investor, the asset one's P&L is actually none of that customizable fund's business. I hope that sentence makes sense, right? So that technically it gets abstracted away at the property level. But here is the rub. The rub is, let's say you travel to visit asset one, and then over here you pay some accreditation letters for asset two, and then you pay some hotel fees for asset two, okay? And then maybe like pay cash portal for asset two. You don't want to take those expenses and then allocate it to asset three. So how do you spread them? Right? That's where like you have to like, sometimes if you pay across them, they will actually pro rata based on each asset's allocation. So whatever you save on PPM, you have to do that part of the accounting. So the accountant then create a unified K1 on your behalf. It gets more complicated. Each one of those has LPs, but some expenses for some properties in some states for some investors cannot do not have certain tax benefits. I don't know the details, but a California investor will be entitled to certain things if the property is in some other state or in California. And so you have to take that into account. So you need this very specialized accountant that can do your books. So it's not clear. Let me go back to the point. It's not clear that it's cheaper, right? Before, you only have one problem, which is investor might be across the state. And yes, you have to do blue sky filing in a bunch of them. But the expenses don't matter. The expenses is just at that single purpose vehicle level. And so you subtract them and that's it, right? There's no of like, this expense could be applied to all 3 assets. And this expense could only be applied for this asset. So I need to prorata the expense based on which asset it gets used. So you end up with investors is a problem, they are in different states. You have a compensatory expansion against the number of assets you have, and it could get unwoody. Can we solve that problem? Yes. Is it worth it? Sometimes, especially if you're not raising that much money. So there is a continuum, which is if you're only raising 250K to 500K, it is worth it because you don't have that much expenses in the first place, and you don't have that many investors usually. And so there's that. All right. So that is my general explanation on the cost. Any comments or questions that about customizable funds? Is this what you expect on the cost, or you always thought that it's cheaper with customizable fund, and that's why people do it? Mhm.
Yeah, I can just comment on the early stage venture capital that the company that I'm with, we do a Delaware Series LLC, and the investors truly do like receiving 1K1 for all of the investments that they make in each calendar year. Some investors could be investing in 5 to 10 deals every single year. And then once you start doing this for 5, 10 years, if you're not doing the special purpose vehicle, the Delaware Series LLCs, just the number of K1s that they get is a bit overwhelming. So it does provide kind of a really good way to provide your clients, your LPs, with simplified back office accounting.
I like that. Thank you.
Yeah, so I guess the way you've structured this, Perry, we do a customizable. We spin up a Delaware Series LLC for each year, and then we allow our investors to participate in the deals that they want to participate in, and then they can pass on the deals that they don't want to pass or that they don't want to invest in.
I love that. So you are an example where the pros outweigh the cons, and one of the biggest one is the fact that LPs get a single K1 is a huge pro LP move. That makes
Yeah.
sense.
Now I'll say the downside is that in order to produce that single K1 at the end of the year, all of the portfolio companies, or in your case, all the properties would have had to have done their accounting, right? One property or one investment can hold up the entire K1, not just for that one investor, but for all of the investors. So it's very common to file extensions, because I don't even know if we've ever had all of the companies uh, give their financial information or tax information to us on time.
I love that. That's a great point. Yeah, I love that. Thank you.
Mhm.
It's really, really good. I love it. Cool. That makes a lot of sense. That's I love this. Cool. Also, let's go also to into convenience. So convenience, I will say within the convenience, there is the convenience for the LPs, and then there's the convenience for the GPs. Okay, convenience for the GPs. Okay, okay. The convenience for the GPs is that they can always be in equity raising mode, right? So from the moment they say I want to raise for you, they can just put it in, create a disclosure form for this new asset, add that thing to their software, and then they're ready to go. The downside there is they do have to spend time managing the books and just allocating the expenses and so on. Okay, so there's that. Now the convenience for the LPs, the upside is single K1, that's for sure. Okay. The other one is not so much convenience, but more of this like feeling in control. I can actually imagine that customizable fund is more useful for venture-backed startups, where some people just have a very big passion for certain types of startups, right? Like they only want to do certain, prop tech or AI or whatnot, or they want to pass on certain things. So that actually feels pretty good. And some people may argue that for real estate is similar. I just never want to invest in, say, mobile home parks, even though I should do. Some people say I only want to do industrial, so I pick the things I like. So feeling in control. The downside is that also this depends on what LPs like. That the purpose of um, the fund manager's job is basically help allocate money. Okay, one of their biggest jobs is that I will do all the math for you. I will vet these GPs and I will allocate your money on your behalf. Right, that's the fund manager's job. It's almost outsourcing that job to the LPs. Like, okay, you decide. I can only tell you every one of those deals is pretty good, but you decide how much you want to invest in. Okay, so that's why it's the pretty advanced version. We move from fund managers in control, so help you diversify. And so LP only has to put in the money and then just kind of forget about it. Where now is LPs have some kind of decision making on how much money they want to allocate. And sometimes that decision making could be good. Sometimes it could lead to um, choice analysis by paralysis. Okay, so that's that. All right. So I will say on the convenience thing, it might be a toss up there. Okay, cool. All right, cool. So let's also talk about a couple more things. If you are a lead GP, so if you are, say, Joe Fairless, Ashcraft Capital, and you owned your own properties, okay, meaning you are the GP, and you actually buy, say, 2 or 3 properties at a time. Do you want to use customizable fund, or do you want to use just a traditional, first fund 1, fund 2, fund 3, and so on? Here is one of the other cons of customizable fund is most of the time it's limited to 99 investors. Okay, I won't get into the details on that, but most of the time it's actually limited to 99 investors. And so with lead GP, they're trying to raise $20 million. They're basically bottleneck by that. Okay, by the investor limit. Now there are ways to get around it because they own their thing, but most of the time, lead GPs don't use customizable funds. Okay, customizable funds are most adequately used by fund of fund managers. Okay, they are for folks who are raising about 250K to 500K to a million. Okay, and that is great. That is great for them. And in that case, they are limited, less than 99 investors. They don't mind do a little bit of the accounting work. They don't have to pay the paperwork, pay for the legal costs on every single one they're raising for. And the other thing is a lot of the large groups, large syndications by reputable GPs, minimum investment could be 500K to a million. Yeah, it's certainly the case, as Paul mentioned, for venture capital. Like just a minimum check size is 500K, take it or leave it. And for some of the larger development deals and multifamily syndication, that's also the case. And so customizable funds. So the takeaway is customizable funds provide a really good workaround for fund of fund managers that have diverse interests and connections, and they can raise for different things. Okay, it does provide a pro LP benefit by combining the K1s. That is definitely a benefit. Okay. And then it provides a lower barrier of entry to LPs that want to do say 25K or 50K that otherwise will not be able to invest in institutional grade funds or assets. Okay. So whenever institutional grade do a syndication, their minimum investment is usually 250K, 500K, or $1 million. So those are my takeaways. Let me pause there and see if and maybe folks who haven't done a customizable fund, hearing this, do you think this is a good vehicle for you folks?
Yeah, so I'll just say 2 things. We kind of do both. We have a fund that's more of a passive. You kind of give us the money and then we allocate it. And then we have more of a customizable fund where the LPs really get to make their investment decision. And we're trying to cater to really some investors that want to be actively involved in the process, and then some other people that simply don't have time to do their own due diligence. They can put money into a special purpose vehicle and then allow the managing director or the portfolio manager make those investment decisions for them.
I like that. So you have two funds, and that will cover the whole spectrum. I like that. Yeah. And then on your usually is the SPV or the customizable fund more popular? Like which one gets filled out faster?
In our experience, we deploy about 10 to 15 million dollars per year on an annual basis, and most of the money, about 2/3, comes from the investors, the active investors investing their own money, choosing their investments, and about 1/3, or about 5 million, 4 to 5 million, comes from the fund where the GP makes the decision, the SPV.
I see. So SPV. Okay, so 2/3 actually comes from the customizables Delaware series.
Delaware's, yeah.
Okay, that's cool. So you actually raise a lot more money on the. Do you have that 99 investor constraint, or because there's so many repeat investors, you don't have that constraint?
Yeah, so I forget what is it, a 506B restriction?
I
We
think it might be something else. The
see,
second, yeah, the
yeah, so we're not limited to the number of investors, but we can't advertise,
okay, sure.
yeah.
Got it. No, okay, so you don't have that side. Okay, cool, excellent. I love it. Cool. Chris, I know you are starting a potentially a single family fund. Um, do you imagine that you're gonna create a customizable fund for single families?
Um, if I would see, it'd probably be like those closed funds. I can't see just more for organization. It seems like I also like the sense of urgency. I think it gives the when there's a start and end date. I know I've heard some GPs talk about having that sense of urgency, like for certain hurdles, like when you're one of the first investors, you get better returns.
Mhm.
Um, but then also if there's an end date, your investors are more likely to kind of make a decision, whereas if they just see it once in a while and they know they can always invest whenever they want, they'll kind of just keep looking at it and never make a decision. Um, so I think that sense of urgency is a big thing with those closed funds, so I kind of like them better.
I love that. That makes sense. Very good. Cool. Mm. I also recommend, Paul, question for you. When you are starting out, did you do a SPV first and a couple SPVs later, you do the customizable fund, or you went straight to creating a customizable fund?
Yeah, so no, when we first started, basically each individual investor was a single line item on the cap table. And eventually, going through the SPV, you invest in the SPV, and say you get 20 investors putting in $100,000 each or whatever, right? Then you become one line item on the cap table, which is a little easier for the entrepreneur, right? Less for them to keep track of, which is really good for them. But then as the investor network got bigger, we have about 550 accredited investors in our network right now.
Mhm.
And if everybody decided to participate in one deal, that's 550 line items in your cap table.
Yeah.
And if it's your first time doing a property, it's a bit overwhelming. You would much rather just say, I got one limited partner, and that's made up of a bunch of investors. But since we've grown so much, yeah, no longer do we do direct investments individually. Now, if somebody decides as a network, if we decide we don't want to invest in a deal, we cancel it. Then the individual accredited investors can decide to make their own investment decisions outside of our network, right? We don't have that restriction. They can do their own investments outside of our network, which is fine with us. We've decided that it's not a good deal for us, and they're free to do whatever they want to at
That's
that
awesome.
point.
How do you poll for the fact that enough threshold has been met? Is that just a Google spreadsheet, like a Google form, or you actually create a software to get that
Yeah,
poll?
we have a due diligence process that we go through, and out of the investors, we form a due diligence committee. And it takes about 30 to 60 days to go through the due diligence process. And then they come back with a report. And from that report, most of the other investors rely upon the due diligence that, their fellow accredited investors performed and will make their investments. And then we have a couple of triggers on the passive side. I think it's like at least 10 investors have to invest at least $100,000, right? If that, then the fund can come in, invest dollar for dollar, or if the GP wants to leverage that up, they can maybe go up to $2 from the fund for every $1 that the accredited investors put in.
I like that. And then this report is just shared using the email chain, and they responded by just replying to the email, or there's like a way for them to.
Yeah, we got a website, like a public facing website, and then a member only website, and then the deal flow, the due diligence, all that is on the member website. And then once we have the capital call, right, then it goes onto a platform very much like cash flow portals, where the investments are held, and you have the portfolio management side of it.
Got it. And then when they make a interested statement, are they obliged to invest?
What did you say?
Like say LP say I'm interested, and there are 10 of them, 100K each. And so like, okay, we're moving forward. At that point, is the LP obliged to do it to fulfill the capital call?
Yeah, so that's kind of get the soft commitment. We do early on, we kind of gauge interest. And at that point, it's just soft commitments. Of course, anybody can back out up until the day that the deal closes. And we run pretty much on the soft commitment. I'd say 95% of the time, if somebody says they're going to invest, they invest. They have done their due diligence and they're ready to invest. Very rarely does somebody not invest that says that they were going to. And many times those are due to last minute lifestyle changes. Something happens in their life, and they just can't fulfill their obligation, and we're fine with that.
I see. Yep, that's amazing.
I have a question about the soft commitment thing, because I'm newer to like raising capital stuff. Would you say that's kind of a norm all around, where like if someone kind of gives you a good soft commit, they're probably gonna go to the end? Is that kind of like a common theme?
In my case, I've been doing it for 9 years, and I know my investors, and so I know early on they're either going to tell me I'm in or I'm out, right? So if you don't have that track record with your investors, then I don't know what to tell you. You'll get to know your investors though, really fast.
Yeah. I will say soft commitments, yeah, it depends on every person and depends on if you're doing a fund or syndication. I do think when you get more experience, the fund experience becomes more and more like a syndication experience. And in my syndication, I will say your soft commitments is about 90% of your close to your actual raise, sometimes even less than your actual raise. It doesn't mean that everyone in your soft commitment list will end up investing. That's not what it means. It means that there will be some people that back out, but there will be other people that never fill out that soft commitment form that end up investing. And then it also means that you're gonna get more investors in addition to the ones that are on your list. And so it provides a good heuristic. So yeah. Great.
But you make a good point, because at the very end, until you fill out that form and sign the docs, somebody might increase their allocation, right? They just decide at the last minute, I'm in for an extra 50,000 or whatever it might be. So
yeah, that's right. Excellent. All right, cool. So this is the customizable fund. And then next week, we're going to talk about how to raise more equity in the long run. And then between this week and next week, we'll have sent out our monthly update to our customers. And as such, we hope there will be more folks joining. and I'll just keep pushing it until I want to do at least 50 of these before we say, okay, this is a good use of time, but I feel like I'm learning something from folks and from different asset classes as well. And so I already have some ideas. Yeah. Thanks everyone for your time. And so we need about 10
Thank you.
I appreciate it. Have a good weekend.